Is it better on your end to try to foreclose on the property and try to buy it at a discount? Or is it better financially to try to work something out with that homeowner and just almost like create an income stream?
It's more lucrative, especially in the short term, if we just turned around and foreclosed on all the homeowners and took back the properties, especially with these equity spikes. We would clean up and just press on from that point. But we chose to do the opposite, and it's a long-term play, and that is create these long-term streams, create multiple drips of passive income coming into us every month, every day, as a matter of fact. And we feel like that's the compassionate thing to do because we're helping families not be displaced and stay in their homes.
What would I need to do to get started on something like that?
But reading books, my first book, Note Investing Made Easier. I've written Note Investing Fundamentals, Cash Flow Dojo. You can get them all on Amazon. But don't just stop there. I mean, obviously, read as many books as you can. I think I read 10 books or so, and then went out and still didn't really know what I was doing, and that was due to arrogance because I was landlording for a while. I'm still landlording, but I was landlording, so I thought that I knew everything, and there was just so much I didn't know about the due diligence process.
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Residual Real Estate Agent. This is show number 123. Today, we've got a very special guest. His name is Martin Saenz. He's out of Sarasota, Florida. And today he's going to be talking to us on how to invest in mortgages or notes, either performing notes and non-performing notes as it relates to real estate. Welcome to the show, Martin. How are you?
Hey, I'm doing well. Thanks for having me on, Jose.
For our viewers who don't know who you are, would you mind kind of just sharing a little bit about yourself and how did you get involved in this wonderful world of real estate investing?
Yeah, I'd be happy to. I think my entrepreneurial journey started about '04 after leaving a corporate job and reading Rich Dad Poor Dad, right? Like, who hasn't done that? And my wife and I just went on a journey of learning and taking seminars, and we ended up starting a small business that sold to the federal government in '05. And as a result of doing that, we bought our first commercial building in '09 as a landlord, and then bought the neighboring building a few months after. And then we just started buying properties as a landlord. And fast forward a few years, 2013, we sold our company, the government contracting company, and I was left managing some properties as a landlord and looking for the next opportunity. And the two things I really wanted to accomplish with the next opportunity is I wanted to stay in the real estate world. I wanted to work on creating true passive income and financial freedom in my life and in my wife's life as well. And also too, I wanted to be of greater service to society, if you will. And I ended up going to a local RIA, real estate club, and ran into a mortgage note investor. And I was hooked after that. That's really how I learned about it and started reading books on it and went out and bought 10 mortgage notes out of the gate, not knowing what I was doing.
That's awesome. And for our viewers that don't know maybe what a mortgage note investor, what is a mortgage note investor and how does someone invest in mortgage notes?
If you take the case, obviously there's various types of notes that one can buy, but in the sense of what I do, if you take a mortgage loan that's originated at a lending institution like Wells Fargo or Deutsche Bank, and it's underwritten through the bank with Fannie and Freddie underwriting guidelines, and at the point of closing, a promissory note's going to be signed by the person borrowing the money, agreeing to paying back the lender given a certain set of terms, and a security instrument like a deed of trust or a mortgage document will be created that ties that promise to the property. And so what happens in 4% of the cases is those mortgages go into default. Something happens in the homeowner's life, like a divorce or health or job loss, and that person's not able to make their payment. And what a lender will do over in some cases, they're going to bundle these non-performing mortgages into pools and sell them off into the secondary mortgage market to a hedge fund like ours at a discount. And what we do as a practice for our company is we buy these mortgages in, we make contact with the homeowner, and we try to look for a win-win situation where we could come find out where they are today financially, work on a plan that fits their budget to help keep them in their home while creating a loan modification, which is a 20, 30-year cash flow stream for our company.
So it's basically you guys are buying non-performing notes most of the time, and then it's trying to come up with a win-win situation. But let me ask you this: is it better on your end to try to foreclose on the property and try to buy it at a discount, or is it better financially to try to work something out with that homeowner and just almost like create an income stream?
No, it's no, there's a clear answer to that. It's more lucrative, especially in the short term. If we just turned around and foreclosed on all the homeowners and took back the properties, especially with these equity spikes, we would clean up and just press on from that point. But we chose to do the opposite, and it's a long-term play. And that is, create these long-term streams, create multiple drips of passive income coming into us every month, every day, as a matter of fact. And we feel like that's the compassionate thing to do because we're helping families not be displaced and stay in their homes. These are good people. What we have found over the course of years in modifying and working with hundreds and hundreds of borrowers is we find that these are good individuals. They qualified for the mortgage out of the gate. They just ran into a life circumstance that I mentioned previously.
And if I wanted to get, like, let's say into mortgage note investing, what would I need to do to get started on something like that? Like, where would I even look? Is it something that you have to have like a big account with a bank already? Is it something that you have to have some sort of relationship with somebody, or how would somebody go about doing that?
They should start like I started, and I would recommend. And I've written 3 books on the mortgage note industry. I'm considered a thought leader, but really I'm just passionate. I'm just passionate about how this can be done in a humane way and create just numerous streams of income for yourself. And it's just such a win-win that so many real estate investors overlook and are not taking advantage of. But reading books, my first book, Note Investing Made Easier. I've written Note Investing Fundamentals, Cash Flow Dojo. You can get them all on Amazon. But don't just stop there. I mean, obviously, read as many books as you can. I think I've read 10 books or so, and then went out and still didn't really know what I was doing. And that was due to arrogance because I was landlording for a while. I'm still landlording, but I was landlording. So I thought that I knew everything. And there was just so much I didn't know about the due diligence process.
And then why mortgage note investing versus just like traditional real estate? Like, it almost seems like it's a little bit more of a niche. Obviously, is it because it's less competition? Is it because less people understand it? Is it because the margins are larger? Is it because you can create better income streams? Why that versus just the traditional approach to just buying undervalued assets?
Just take a look at this marketplace now. I mean, when you're buying value add properties, that's where you're going to get the bang for the buck in this marketplace. But you're going to have to put in the sweat, fix them up. Material costs are going up. There's labor shortages. There's all kinds of grief and aggravation that comes along with managing a property. And then once you get it up to speed, everything's deteriorating over time. The roof is going, as we speak. I mean, I'm just thinking about my properties, and I when I think of my properties, I think of in terms of, oh, the HVAC's 10 years old on that. How much life do I have there? Oh, the roof is this, and that's how I think about when I think about the properties I'm landlording. And so it's just like a ticking time bomb with a mortgage note. I mean, think about like $100,000 mortgage loan. I paid $40,000 for it. I got in contact with the homeowner and I did a loan modification at par. That's $100K. So I created 30-year cash flow stream, at $100,000 unpaid principal balance. Now, with that said, it's a convoluted industry. There's a lot of regulation. There's a lot of maneuvering through the muck and mire to kind of get yourself situated. But what business doesn't have that?
I feel like it almost like whenever there's like that barrier to entry, which is the knowledge in this case, it almost makes it so that there's less competition or less people getting involved in it, which obviously makes it, if it was easy, everybody would be involved in it and everybody would be making millions of dollars. Is that pretty typical? That example that you gave us was like almost like 40 cents on the dollar. Is that typical of the industry, or is it like 20 cents on the dollar, 30 cents on the dollar, 50 cents on the dollar? What is typical, or does it depend on the like loan to value ratio of the notes that you're buying?
Yeah, like you said, there's metrics, and depending on the quality of the mortgage, how much equity coverage is it? What's the underlying property valued at? That's the collateral that's backing this whole thing. What is the caliber of the homeowner with a credit risk analysis done? What does the O&E, the title report look like? How clean is it? Is it an owner occupied property? Is it a non-owner occupied property? I mean, the list goes on in terms of what that determines the value. You can buy a mortgage loan for 10 cents on the dollar, and you're going to be busted out of the gate. I mean, you just pretty much gave away money, and you could buy a non-performing mortgage note for 60 cents on the dollar, and there's some value to it. It really depends. And we buy performing mortgages. We have an income fund that's separate from our non-performing hedge fund, and we buy only seasoned performing mortgages in that fund. So I understand kind of both sides of the business.
So, whenever you say performing versus non-performing, just for maybe some of our newer viewers, do you mind explaining what the difference is there?
So non-performing is the payment hasn't been made by the homeowner past 90 days. So they're past due 90 days and beyond. And in many cases, when we're purchasing these non-performing loans, they are 3, 4, 5 years in default. And that's not, I know at first you're like, oh my goodness, why would anyone do that? But if you think about it, if someone goes through a divorce, someone loses their job, you almost need some time between that occurrence and where things are at right now. So time can be your friend in that regard, and you're also getting it at a discount. So which is kind of incentivizing you to look at that opportunity. And we buy these in pools. We buy these in large pools. So we don't rest our hat on one mortgage loan. We're buying 100 mortgages, and we're kind of understanding the numbers as an aggregate purchase for that.
So, where would I go if I wanted to buy 100 mortgages? Is there like a website where people go to? Is there like an account that you have to have? And what is that? What would that process look like?
When you're buying larger trades, you're buying outside the retail setting. So like on the real estate side, you're in the MLS, you're in CoStar, you're buying onesie twosies. But when you're buying more at an institutional level, it's based on relationships between hedge funds and banks, and hedge funds and hedge funds. And there's already pre-existing relationships in place with negotiated trades, certain understandings that are in place, and track records and things like that. So with that said, that shouldn't discourage someone. I mean, you got to pay your dues. Like I paid my dues. I didn't come out of the gate and start buying 100 mortgage pools out of the gate. I came out, I overpaid. I paid in the retail setting. I learned due diligence from like not knowing due diligence. I did everything incorrectly once. So then, so I got to the point where I'm at now where I kind of know what not to do. But like with that said, someone should read books. They should attend conferences. They should learn due diligence and asset management before they try to beef up their sourcing efforts, because the real players in the industry know real knows real, right? Fake knows.
I was going to ask you that next. What are some of the mistakes maybe that you made early on as it relates to mortgage note investing? And maybe what are some of the mistakes that you've seen other people make as well too, that maybe people could avoid by just getting a little bit more educated or getting their systems in place?
So out of the gate, I identified a 10 mortgage opportunity, and I went and drove from my home in the Washington, D.C. out to Ohio. And all the properties were in Ohio. And I went and drove around Ohio like a nut for 2 weeks. And because my whole mindset was, I have to understand the property. And that's where a lot of the real estate investors that come to the mortgage note side have difficulty transitioning, because their whole mind is, how do the windows look? How does the landscaping look? Because that's a reflection of the inside. They start thinking of all that, all these shortcuts and, rules of thumb. But the truth of the matter is, when you are buying, if you're buying with the focus of helping the homeowner stay in the home, then a healthy portion of due diligence needs to be on the homeowner and their ability to pay before you buy the mortgage loan. And if you do that, then you're going to minimize drastically the number of occurrences where you have to foreclose and take back the property through auction.
So they're almost taking a look at it like, what is the house worth? And they're almost like, the first thing in their mind is like, I'm going to be able to foreclose and I'm going to be able to take this asset back. But I imagine that's a lot lengthier of a process, and also a lot less satisfying, I would imagine, as well too, because I would imagine working with a lot of these homeowners would obviously bring some sort of satisfaction. I wanted to ask you if you'd be kind enough to kind of walk us through the due diligence process. Like, let's say that I'm offered a 100-note portfolio. Like, what should I be looking for in the due diligence?
You'll be looking at property valuations. You can do everything short of an interior inspection. And so you're going to look at online resources. You're going to do BPOs, things that, and triangulate data to determine what the fair market value is. You pull a title report so you can understand lien validity. Is the lien even valid that you're purchasing? Because in this world, in this side of the fence, it's the Wild West. There's no pretty people at the title company giving you coffee and attorneys walking you through all the legalese of the closing documents. That doesn't happen. It's you looking over a contract, maybe having your attorney read it over, and wiring funds to someone across the country or world. So it's buyer beware. If you buy a loan that's not valid, it's on you, because you should have done your due diligence. Credit report analysis. We pull credit, we do skip tracing, we do background checks through Pacer to understand bankruptcy filings, and we kind of piece all the data together to determine, how it fits into our pricing model.
And then when you say BPOs, lien validity, also credit, do you, like, if you're offered a pool of 100, is that something that they provide you and you just have to verify? Or are you doing your own BPOs for every single property when you're offered the pool? And then also, how long do you have to pull the trigger from the time that you're being offered the pool? And also, what is the pool, what is given to you in the information, like address, name, social, maybe date of birth? Like, what type of information are you guys able to receive to be able to do all of this due diligence?
Yeah, you're essentially getting an Excel spreadsheet and digital copies of the collateral file. That's all you're going to get from the seller, and everything else you need to make happen. So it's very capital intensive. I mean, you need to have money. You need to be able to pull out money. You really don't want a seller to give you a pretty package with a bow tie on it, because that just means they probably shopped it around everywhere.
So if they haven't done that, it's almost like, hey, look, here's what it is. Do your own research. Do they give you a price along with it of what they want, or are they having you make an offer based on the information that you found?
You get it both ways. Sometimes you get color, sometimes you don't.
And then, like, let's say that you do buy the non-performing note. Does everyone qualify for a loan mod automatically, or like, are they having to provide like certain documents in order to be able to qualify, or what is it that you guys are looking for to see if somebody is going to qualify for a loan modification?
We buy mortgages with the intention of creating a loan modification that works within the homeowner's budget. So, we want to understand what they're paying on other mortgages, what they're getting in income, and what their financial situation is. Are they remarried? What does their spouse do for work, and that kind of thing. So once we understand that, we're going to create several options for them. So to give some empowerment to the homeowner. And, usually if they've been past due for a few years, we're looking for some down payment. So we might give them a few options with a few different looks in terms of monthly payments and down payment types, and that, so that way we give some options for them to get back on track with things.
As it relates to the loan modifications, I know that you said you give people some options. Is it generally like extending the term of the loan? Is it generally like putting a balloon payment at the end? Is it ever like where you guys are reducing the interest rate? Is there ever like principal forgiveness? Can you kind of walk us through some of the most common ways to be able to provide somebody with a loan modification?
Yeah, I think you just hit them all. I mean, we can extend a term, we can lower the interest rate, we can lower the principal balance, we can lower the past due interest arrears. I mean, when we purchase the mortgage, we assume all the rights and responsibility of the original lender. So we essentially become the bank at that point. But we have less regulation and we have more flexibility in a positive way to go and work with the homeowner. And the thing is to try to help them as much as possible. And so we don't raise interest rates. We don't do anything like that. Our goal is to give a sustainable loan that's going to be paid on for 20 to 30 years.
What are some of the regulations that a big bank would have as opposed to maybe like somebody like you?
The regulation applies to everyone. There's just certain ways that banks can work through Delaware Trust and other kind of high level operations or structures that are probably beyond kind of our discussion here, but they can have exemptions from certain regulations. But for us, I mean, we look at state by state. There's more and more regulations coming into our industry. So we're having to look at debt collectors licenses. We're having to look at servicing licenses in some case, and registering with states and counties and things like that. So it's an ongoing effort to be in compliance, but it's needed. And I think that's one of the factors that kind of scares away a lot of real estate investors is there is this regulatory burden on our industry.
From the time that you guys get the pool of loans, how long from the time that you guys take ownership of those? What is a typical period to get some of these non-performing notes performing? And then also, like, once you get them performing, also the value just went up. Do you guys ever resell the performing portfolio now that you guys have gone through that process? And what is the difference in pricing as well too? Like, let's say you take a non-performing pool, you buy it at 50 cents. What is it worth now that it's performing?
We had over having done this since 2013, we've accumulated a large portfolio of performing mortgages. So in 2020, we launched Bequest Funds, which is an income fund. And what it is, it's a 506c Reg D. So we work with accredited investors and we pay them 9%, a 9% return, and we make our payments monthly. And so we buy in performing mortgages, re-seasoned mortgages from our own hedge fund, as well as other third-party hedge funds that do the same thing. And so we buy them in at an 11, 12% yield, which allows us to comfortably pay out our investors at 9%. And that's been great. I mean, we're at, I think, about 16 million, soon to be about 20 million with mortgages under management there. And it caps out at 50 million. So we should probably close that fund in the next 2 years. Will be closed out there. But that's our long-term play. That's a legacy play for us.
I'm an accredited investor as well too, and I invest in like self-storage. I invest in multi-unit properties as well too. The reason I do that sometimes is because of the tax benefits as well too, the depreciation write-off that I get. Are there any depreciation benefits when it comes to mortgage investing? And I'll tell you this, the part that I like is that with some of the other funds, they sometimes pay quarterly, not monthly. And I think that like is huge for people looking to maybe diversify a little bit and build like a nice income stream. Because if we think about it, like most people's bills or financials, everything is monthly. So if you have a nice income stream monthly, I think it'll help people.
Yeah, no, we intentionally did that. Look, here it is. We receive borrower payments monthly. So why should we not pay our investors monthly? It's fair. It's what's right. And I'm the largest investor in the fund. So although I'm adding to the fund and letting it compound and all that, because it compounds at 9.39%, what's right is right. I don't agree with quarterly payments or semi-annual or fluctuating pref payments and all that. Like, we want to be old reliable. Like, what you're getting with us. You know what we're spitting out at the beginning of every month to you. Now, in terms of what the value, when if we buy a mortgage loan our average mortgage loan that we buy into our fund is at 68 cents on the dollar. So it's between an 11 to 12% yield. So what we look at from a metric standpoint is investment to value. So our investment to value is at 58.58%. So what that means is if there's a property worth 200,000, we're in that investment for no more than 130,000. So that's how we maintain being a conservative fund and allowing for an equity cushion. But it all stems this whole thing's possible because we're buying these mortgages in at a discount.
That's awesome. So it's almost like buying a property without any maintenance, without having to worry about the roof because the homeowner is going to do all that, and buying it at 58 cents on the dollar. So I talk up to some of our viewers sometimes about buying property 75 cents on the dollar, 70 cents on the dollar. But even then, you're responsible for roofing, plumbing, electrical. Here, you're not responsible for any of that. Obviously, there's some hiccups. Did you ever tell me like how long from the time you guys get buy the loan, how long it typically takes to get it performing?
Yeah. So what's interesting is we're buying in pools. So if you buy 20 mortgages, you may have some that start performing in a few months, and then you may have some that take a year and a half to start performing. But most will hit right in the middle, a 9 to 12 month point. You'll get that pool turned around.
Basically. So if you're getting into note investing account for some time, don't think that you're going to get these notes performing like right away. Some of them may perform right away, and then obviously some of them are going to take time. And when you said that 68 cents on the dollar, I think you said that is the average of what you guys are buying them at. Is that the average between non-performing and performing, or is that mainly for non-performing? And how would that number be different if it was performing as well too?
No, that's our performing
Oh, performing.
for Bequest funds. Yeah, for our income fund. Yeah.
Wow.
So it's a percentage of principal balance, the 68 cents on the dollar. And our investment to value, which is our equity coverage backing that mortgage, is at 58%.
So let me ask you this. Why would somebody sell a performing note for like almost 70 cents on the dollar? Like why?
Because if they bought it in at 30 cents on the dollar, they 2x their money and they're out within a year.
So just basically, I forgot the term, but it's like the cycling of money, basically.
Yeah, recapitalization is what they're just doing. I mean, there's hedge funds. I can't speak to all of them, but I mean, there's hedge funds that take on our hedge fund's private. It's just owned by my partner and myself. So we don't have any investors in the non-performing hedge fund. But there's a lot of hedge funds that are, investor led, and they want to return capital to their investors and go out and buy and rinse and repeat, so to speak.
How big is the market right now for note investing? I know that obviously, like, I would imagine there's cycles like anything. Like, there was a time where there was a lot of foreclosures in 2008, 9, 10. I would imagine that was like I don't even know if that was a good time to get into it. But are there better times to be a mortgage note investor, and are there worse times? And then what determines that? Is it the amount of non-performing notes? Is it what's going on in the real estate market? What determines whether it's a good time to invest in mortgage notes or not?
I'd say that's relative to the investor or hedge fund. It's really interesting. All I can say is that when I started mortgage note investing, I could easily buy non-performing notes under 20 cents on the dollar. And there was, they were falling from the sky. I mean, you could pick up as many as you wanted. And however, there was not the healthy equity coverage. There was a lot of bankruptcy filings when you try to work with the homeowner to get them back on track, and so there was a lot more legal and workout difficulty involved with those mortgages. And fast forward to today, inventory is dried up for all but a few players in the industry, and there's the retail market is almost non-existent in the mortgage note space. Probably same thing, right? You go to the auction to pick up an REO and you probably have 100 people, bidding for 10 properties or whatever. No difference there. So the retail settings has been dead for, a year or two, and pricing has gone up. But for the players right now, I think it's the best time for us because we have existing relationships in place where we've traded millions of dollars over the course of years, and we're known and trusted. and respected, and we do what we say we're going to do. So we have, we have a pipeline of trades that we're always involved in.
I love that, man. So you put in the work, you build a good reputation, you do what you say you're going to do, and eventually you build up those relationships. What about the retail setting? Like, what websites? I remember hearing about certain websites for retail. I just don't remember the names. Are there certain websites for the retail, or how would I go about finding something like that? Is that just something that I go on Google and Google mortgage notes non-performing, or even what would I Google?
I used to go to FCI Exchange, but they, terminated a while ago. Paper Stack is another one that they're up and running, and I know those guys, and they run a great operation. That's actually the only one I know of.
It sounds like you started off in the retail. And now, obviously, you've built some great relationships now where you guys have access to, and that's good for your investors as well, too, because that means somebody like me, if I'm investing in your fund, it would take years, maybe even 10 years to establish the type of relationships that you guys have developed already. So that gives somebody like me an advantage because I'm just the money guy when investing with you guys. So what are the different hats that somebody would have to pay or play? So it sounds like you're a debt collector, meaning that like a portion of it is reaching out to the homeowner, asking what their situation is. Then you said something about asset management. Like, what would asset management be if you're not responsible for anything for the property, right? You're not responsible for the roof, the plumbing, or is asset management in the way that you're describing it something different than what I'm understanding?
I look at note investing as having four phases. The sourcing is the first one, and due diligence, asset management, and portfolio management. So you need to have someone dedicated on the sourcing front, going to conferences, building relationships, doing all the marketing, and drumming up deal flow. And then you need to have an acquisitions team that's ready to perform due diligence on these opportunities when received. And then asset management is exactly how it says. You're managing a portfolio of mortgages, whether they're performing or non-performing. If it's performing, you still have to monitor that daily. We have a controller, we have an asset manager that work daily to monitor the performance. So if someone is not paying as they should be, we need to contact them and find out what's going on. And so on the non-performing side, if we're working with our legal team or we're having discussions with the homeowner to create a loan modification, all that is that's what an asset manager does. And portfolio manager is someone who's just monitoring the performance of the portfolio as a whole. So there's a lot of different hats. When I first started, I did them all. I did all the hats for a while. Yeah, now I'm just pretty much just talking to investors all day. I think that's what I do all day.
What was the last one? There was the sourcing, due diligence, asset management, and you said portfolio management, or what was the last one?
Yes, portfolio management. And I wrote about these four stages. I wrote about different life cycles and all that in the books I've written, and I've been pretty open about, because I'm an entrepreneur at heart, and if anyone wants to take a stab at this, read my books, read other books. There's other great books, and put together a business plan and model and go at it.
That's awesome. For me, I like to be on the passive side now. Like, I like to just wire the money, but I always like learning about it just because. Before I did the self storage, I read some books on self storage investing and mobile home parks. I'm definitely going to be buying the books. Anything else, Martin, that you feel would add value as it relates to this topic, or anything else that you feel that our viewers should know?
I would just say that, what I've learned is to invest in assets that you can control and that cash flow. I think so many people are investing for appreciation. There's so much speculation out there. People are buying, we're going to see a whole deluge of homes hitting the market because investors bought at the top of the market. And once rental rates start to soften, then those people aren't going to be able to cover their debt obligations, and then they're going to put the for sale signs on the front lawn. So you can't buy based on speculation. You have to buy knowing that asset's going to cash flow for you, and whether you control that asset indirectly or directly, just have a sense of what that operator's doing to produce the cash flow, so it's not a Ponzi scheme, if you will.
I've got a question for you. In the last, I'm part of a mastermind. It's called Collective Genius, and there's a lot of different investors in that mastermind. Yeah, and then there's a guy that does mortgage note investing, and he brought some statistics from, I think, a company called Night.com. And he said that there was a lot of non-performing notes right now because of the pandemic. And he kind of showed some graphs as to all the non-performing notes. Is that true? And what does the non-performing market look like right now relative to, like, let's say 2008, 2009? If I know you weren't in the business then, but if you have any sort of connection there, I'd appreciate that.
Yeah, I mean there's an increase in foreclosure going on. I mean that was to be expected, right, with COVID and what's been built up over with the moratoriums and whatnot. But with that said, there's also a lot of lenders working out plans and programs with the homeowners, and there's always a lag between someone going into default and that note being bundled in a tranche and sold off into the marketplace. So I think if there is this opportunity, it's not going to materialize for another year or two at most. I don't think the retail investor will see that. And before the retail investor sees anything, institutional players go and will be having their way at it first. I mean, Warren Buffett says it well. He's like, financial planners and wealth managers, they're just eating crumbs off the table that the big boys left. And I kind of see that with the note industry as well.
And then where can people find you? And then also for all of our viewers, we're going to include the links to his book on the description of this video as well, too, in case anybody is interested in digging a little bit deeper. But where could people go to find you?
Yeah, they can go to bqfunds.com and or email me at martin@bqfunds.com. I'm an educator at heart, so if you just have a general note investing question, email me. It doesn't have to be related to coming in my fund. I like to help people. I like to meet new people. So if you just have any question, or if you do have a question about the fund, just email me at martin@bqfunds.com.
For all of our viewers, or for Martin first, I just want to say thank you for taking the time to share all this information. Obviously, it's something that I appreciate tremendously. I learned a lot. I'm hoping that our viewers learned a lot too. For our viewers out there, this was episode number 123. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful to somebody, make sure to hit that share button and send them the link as well too. And to Martin, thank you so much. I appreciate you and look forward to staying in contact with you.
Yeah, thanks, Jose.
Likewise.